Welcome to Let's Talk Investing, a co-venture of the Globe and Mail and the Investor Education Fund. I'm Rob Carrick, personal finance columnist at the Globe and Mail, and with me today is Claude Lamoureux, for 17 years the head of the Ontario Teachers Pension Plan. Claude and I are talking about risk, and specifically we're talking about how your risk profile should change as you age and you get closer to retirement. Claude, let's take the example of a young person, a man or a woman just entering the workforce in their early 20s, first good job, they've got money to invest. How aggressive should they be in structuring a portfolio?
Well, the first thing that you've said that is interesting is that if you start when you're young, you'll have a lot of money at the end.
I did assume they would start at their young and not waste money.
But it's amazing how many people don't start when they're young. So when you start when you're young, you have a lot of time with you, so you can take a lot more risk. You can be 100% in stock and not worry about the ups and downs. And in fact, you should not watch the stock every day. Stick with the discipline. I want to be 100% in stock, and you stay there.
You're saying you can be 100% in stocks because you've got so many years for the ups to overwhelm the downs.
Exactly. And time is your ally.
Now, let's say you're getting into your 50s and you're starting to look ahead to retirement. You're going to retire, say, at 65. And how should your investing approach change at that point?
Well, you should change, but you should still keep some stock, because the big danger there is what we call unanticipated inflation. If inflation comes back, and like we've had to live through it in the 80s, this is a big risk. So you should, let's say, be 50-50 in stock. And again, the discipline there is to be able to rebalance. If your stock go ahead and you suddenly find yourself with 60% in stock and 40% in bonds, you should sell some of your stock.
Even in the good times, sell your stocks.
Even in the good time, and that's the tough part for most people, is that things go up, and then if it still goes up after they've sold, oh my God, I made a mistake. No. Your discipline is that you want to be at 50-50.
Keep the proper balance. So 50-50 is a good sort of default weighting for someone who's like 10-15 years from retirement.
For a lot of people.
Okay, now let's say you're in your early 70s. You're converting your RSP into a RIF. You're living off your retirement savings and maybe some pension income, maybe some government programs. What type of asset mix would go into your RIF?
Well, you should have a lot more bond at that point. Something that will give you, or stocks that pay good dividend, that have a good history of paying dividends.
So you're talking about generating some income that's coming into your portfolio all the time.
Exactly. You need the income. At that point, you need the income. And so you should be careful to have bonds, good quality bonds, and good quality stocks that pay good dividends.
In closing, Claude, I want to ask you about seniors who've had their portfolios hit fairly hard, and they have to make a mandatory withdrawal from their registered retirement income fund. And what they don't want to do is cash out hard-hit stocks and equity funds in order to fund this withdrawal. And it made me wonder if there are some seniors who maybe have too aggressive an asset mix in their registered retirement income funds. You want to have a little exposure to stocks for the continuing growth, but what percentage of stocks would you have in a RIF?
I would have, at the most 20-25%. I mean, I would try to, again, the principle is the same. You want things that will give you income, because at that point you need income, and that's what you should look for.
So 25% in the stock market and the rest in bonds?
In good quality bonds. And again, there are some stocks that have bond-like quality. I think I've mentioned, infrastructure. And again, these are good stocks that people will need gas pipeline. They'll need water company.
But I guess the bottom line is 25% that will experience the risk of the stock market, and 75% that's pretty safe and solid.
Yep.
Great, thanks, Claude.
Thank you.